This today is 29th April 2026, and what you're about to hear is a market scenario breakdown based on unfolding institutional-style signals and hypothetical stress conditions in the global silver system, not confirmed real-world news or verified financial reporting. This content is for educational and informational storytelling purposes only, designed to help viewers understand how liquidity stress, settlement delays, and commodity market reactions could unfold in extreme conditions. Nothing in this narrative should be taken as financial advice or factual confirmation of any real market event. It begins on a quiet Sunday night in global markets, the kind of silence traders usually rely on because major institutions are closed and liquidity is thin, but at around 11:47 p.m. Eastern Time, early warning signals begin to appear across monitoring systems linked to silver inventory flows in major vault locations across New York, London, and Zurich. At first, these signals are not dramatic, just small inconsistencies in reporting speed and synchronization delays between physical custody records and electronic settlement dashboards. Within minutes, these small irregularities begin forming a pattern that catches the attention of institutional risk desks. Internal discussions start to focus on whether this is a technical reporting lag or something deeper involving reconciliation between physical silver holdings and paper market exposure. Although nothing is officially confirmed, the tone inside trading rooms begins to shift from routine monitoring to active caution, as similar anomalies appear across multiple data feeds at the same time. As Asian markets prepare to open, early pricing behavior begins to show unusual divergence between spot silver estimates and futures contract expectations, while borrowing costs for silver in short-term lending markets start to adjust upward. These movements do not confirm a crisis, but they do suggest tightening liquidity conditions and increasing friction in the availability of immediately deliverable metal, especially in high-volume institutional channels. By the time global desks in London and New York begin overlapping activity again, the focus is no longer on isolated data irregularities, but on whether the system of tracking physical silver exposure is fully aligned with derivatives and ETF-linked positions. At this stage, markets are not reacting to a confirmed event, but to uncertainty itself, and in modern commodity systems, uncertainty alone is often enough to reshape liquidity behavior, risk models, and short-term pricing dynamics across the entire network. As the narrative continues into the next phase of the trading cycle, attention shifts from isolated signals to broader market behavior, where liquidity conditions in silver begin to show increased sensitivity to even minor order flows, and spreads between bid and ask prices start to widen slightly in certain institutional venues, not in a dramatic or confirmed breakdown, but enough to signal that market participants are becoming more cautious about immediate execution and settlement certainty. This kind of behavior often appears when participants begin to reassess short-term risk rather than long-term value. At the same time, discussions inside trading desks begin to focus more heavily on potential causes behind the observed friction, including the possibility of delayed vault audits, temporary reporting lags in custodial systems, or concentrated positioning in exchange-traded products that may be creating uneven pressure on physical delivery channels. While none of these explanations are confirmed, the fact that multiple hypotheses are being considered simultaneously reflects rising uncertainty within institutional risk assessment frameworks. As liquidity conditions tighten slightly, algorithmic trading systems respond automatically by adjusting exposure thresholds, reducing aggressive positioning in silver contracts, and widening internal risk buffers. This type of automated reaction does not require confirmation of a real crisis. It is triggered by volatility signals and uncertainty metrics alone, which can sometimes amplify price movement even when fundamental supply and demand have not significantly changed. Meanwhile, physical market participants, including industrial buyers and large-scale consumers of silver, continue to operate based on real-world demand needs, particularly in sectors such as electronics and renewable energy manufacturing, where silver plays a critical role in production. This creates a subtle divergence between financial market behavior and physical consumption patterns, where financial caution can tighten liquidity, even while actual usage remains stable. As global trading sessions begin to overlap more fully, analysts start emphasizing that what is being observed is not necessarily a collapse in silver markets, but rather a stress phase, where confidence in immediate settlement and inventory visibility is temporarily weakened. In such conditions, price behavior becomes less about directional trend and more about uncertainty pricing, where markets adjust not only to supply and demand, but also to the reliability of the systems that track and deliver the underlying asset. As the situation develops further into the next trading window, silver markets begin to reflect a more pronounced sensitivity to liquidity conditions, where even routine position adjustments by large institutions start to create noticeable price fluctuations, not because underlying demand has suddenly changed, but because depth in the order book appears thinner than usual during overlapping global sessions. This type of environment often signals caution rather than crisis, where participants prefer smaller, more controlled execution sizes to reduce exposure to sudden price gaps. At the same time, internal discussions across market participants increasingly focus on settlement confidence, meaning whether reported physical holdings and paper-linked exposures can be smoothly reconciled without delay. Even in the absence of any official disruption, the mere suggestion of timing mismatches between custodial records and derivative positions can influence how risk is priced, especially in highly leveraged commodity markets, where trusted infrastructure is essential for stability. As volatility adjusts upward in short bursts, arbitrage desks attempt to take advantage of price differences between futures and spot markets. But these opportunities become more complex to execute when liquidity is inconsistent across regions and time zones. In such conditions, arbitrage does not always stabilize markets immediately, and instead can reflect deeper uncertainty about how quickly physical delivery channels can respond to financial pricing signals. Meanwhile, regulatory observers and clearing institutions are assumed to be monitoring settlement flows more closely than usual, ensuring that margin systems and collateral requirements remain sufficient to handle any unusual spikes in exposure. While no emergency actions are confirmed, increased oversight is a standard response during periods where volatility and liquidity behavior deviate from normal patterns across multiple exchanges simultaneously. By this stage, the market narrative is no longer centered on any single cause or trigger, but rather on how interconnected modern silver trading has become, where physical supply chains, ETF structures, futures markets, and lending systems all interact in real time. This interconnectedness means that even temporary uncertainty in one layer can ripple through pricing behavior globally, shaping sentiment long before any official clarification or resolution is announced. As trading continues into the next phase, market participants begin to reevaluate exposure across precious metals more broadly, not because silver has confirmed any structural failure, but because correlated assets such as gold, mining equities, and commodity-linked derivatives often react to shifts in perceived liquidity conditions within one segment of the metals complex. This leads to a cautious repositioning phase, where portfolios are adjusted incrementally rather than aggressively, reflecting a preference for stability over short-term opportunity. At the same time, attention inside institutional research teams shifts toward understanding whether recent pricing behavior is driven more by technical market structure than by fundamental changes in supply and demand. In many cases, what appears as heightened volatility can originate from reduced order book depth, timing mismatches in global trading sessions, or temporary imbalances in futures positioning, all of which can create exaggerated price movements without requiring any physical disruption in supply chains. As liquidity remains uneven across different regions, short-term price dislocations begin to appear more frequently between major trading hubs, especially during transition periods between Asian, European, and US market sessions. These gaps are closely watched by algorithmic trading systems, which adjust their strategies dynamically, often reducing exposure when uncertainty thresholds are crossed, further contributing to short bursts of volatility that may not reflect underlying long-term fundamentals. Meanwhile, industrial demand continues to operate independently of financial market sentiment, with manufacturers and energy sector users maintaining consistent procurement schedules based on production requirements, rather than speculative pricing conditions. This creates an important distinction between financial market behavior and real-world consumption, where temporary pricing stress does not necessarily translate into supply shortages for end users. As the broader market digests these mixed signals, the prevailing theme becomes one of cautious normalization rather than escalation, where participants recognize that periods of liquidity stress in complex commodity systems often resolve through gradual reconciliation of data, positions, and settlement flows rather than abrupt corrections. In this environment, the focus shifts from interpreting a single event to monitoring how quickly confidence in market infrastructure can stabilize across all interconnected channels. As the situation moves into its later phase, market attention begins to gradually stabilize, not because uncertainty has fully disappeared, but because participants start receiving more consistent data updates across custodial systems and trading platforms, helping reduce the level of ambiguity that initially contributed to heightened volatility. In environments like this, even partial restoration of information flow can significantly ease short-term pressure on pricing behavior. At the same time, analysts begin to emphasize that silver market dynamics are often highly responsive to liquidity perception, meaning that when confidence in immediate settlement or inventory visibility is questioned, price action can temporarily exaggerate underlying conditions. However, once reporting systems normalize and confirmation delays are resolved, markets typically begin to realign with broader supply and demand fundamentals. As trading desks continue monitoring cross-regional flows, spreads between futures and spot markets start to narrow slightly in some venues, suggesting that arbitrage mechanisms and liquidity providers are gradually re-engaging. This does not necessarily indicate a full return to normal conditions, but it does reflect improving market function as uncertainty metrics begin to decline. Meanwhile, institutional risk systems begin recalibrating exposure thresholds based on updated volatility readings, which often leads to a measured return of liquidity as automated constraints loosen in response to more stable input data. This process is usually gradual, as firms prioritize controlled re-entry over rapid repositioning after periods of uncertainty. By this stage, the broader interpretation of events shifts from fear-driven speculation towards structural analysis, where the focus becomes understanding how modern silver markets can temporarily experience stress without requiring a physical shortage. Instead, the emphasis turns toward the importance of transparency, timely reporting, and synchronized settlement systems, which together form the foundation of confidence in global commodity markets. As the narrative progresses further, the market begins to reflect a more balanced state where extreme uncertainty has eased, but caution still remains embedded in trading behavior, particularly among larger institutions that tend to adjust exposure more slowly after periods of elevated volatility. This measured approach helps prevent sudden reversals and allows liquidity to rebuild gradually across multiple trading venues. At the same time, analysts highlight that episodes of temporary stress in commodity markets often serve as important reminders of how dependent modern pricing systems are on continuous data synchronization between physical inventories and electronic trading infrastructure. Even small delays or inconsistencies in reporting can influence sentiment significantly, especially in markets like silver, where industrial demand and financial speculation intersect. As confidence slowly improves, liquidity providers begin increasing participation in order books again, which helps deepen market structure and reduce short-term price sensitivity. This does not eliminate volatility entirely, but it does restore a more stable environment where normal trading patterns can resume without the same level of defensive positioning seen earlier in the event. Meanwhile, industrial users continue operating largely unaffected in terms of physical access, though they remain attentive to pricing fluctuations that could impact procurement costs over time. This reinforces the distinction between financial market stress and real-world supply continuity, showing that temporary pricing dislocations do not always translate into physical shortages. By the final stage of this scenario, the key takeaway for participants and observers becomes less about any single alleged disruption and more about the broader lesson. Modern silver markets are highly interconnected systems where perception, liquidity, and settlement confidence can influence price behavior as much as physical supply and demand. Once clarity returns, markets tend to stabilize, but the memory of uncertainty often remains, shaping how risk is managed in future trading cycles. As this scenario reaches its final stage, markets begin to settle into a more stable rhythm, where liquidity gradually returns across major trading hubs, and the sharp sensitivity seen earlier starts to fade, not because uncertainty is completely erased, but because enough verification has entered the system to restore a workable level of confidence among participants. In most cases like this, normalization does not happen instantly, but through a slow rebuilding of trust in data flow, custody reporting, and settlement timing. At the same time, analysts reflect on how quickly sentiment can shift in modern commodity markets, especially in assets like silver, where financial leverage, industrial demand, and physical delivery systems are all tightly interconnected. What initially appears as a dramatic disruption is often revealed, after deeper analysis, to be a combination of reporting delays, liquidity adjustments, and risk repricing rather than a single catastrophic event. As conditions stabilize further, trading behavior becomes more aligned with underlying fundamentals. Again, with spreads tightening, volatility easing, and algorithmic systems returning to more balanced risk parameters. This phase is important because it demonstrates how markets recover not just through price correction, but through the restoration of confidence in infrastructure and information accuracy. Meanwhile, long-term participants begin to reassess how such episodes influence future risk management strategies, especially in terms of exposure limits, hedging practices, and reliance on real-time data systems. Even without any confirmed crisis, events like this shape how institutions prepare for future uncertainty in commodities markets. And finally, as we close this breakdown, the most important takeaway is this: whether in silver or any other global asset, markets are not only driven by supply and demand, but also by trust, timing, and transparency. When any one of those elements becomes uncertain, even briefly, price behavior can shift dramatically before fundamentals adjust. If you found this analysis valuable, make sure to subscribe to Metal Market Insight, because we break down these market stress scenarios, liquidity events, and financial system signals before they become mainstream headlines. And stay tuned for the next update as global metals markets continue to evolve.